What if everything you've been taught about saving money is wrong? Most people believe the secret to becoming wealthy is simple. Save as much money as possible. They work hard, avoid spending, and keep every extra dollar in a savings account, believing that one day they'll finally become rich. But here's the surprising truth. Some of the wealthiest people in the world don't rely on saving alone. Instead, they use their money in a completely different way, one that allows it to grow even while they sleep. So, does that mean saving is a bad idea? Not at all. The real question isn't, should you save or invest? The real question is, when should you save and when should you invest? Making the wrong choice can cost you thousands or even hundreds of thousands of dollars over your lifetime. Imagine two friends, Alex and James. Both graduate from college at the age of 25. Both land similar jobs. Both earn around $60,000 a year. And both decide to put aside $500 every single month. At first, their financial habits look almost identical. They avoid unnecessary spending, live within their means, and stay committed to building a better future. But there's one important difference. Alex believes the safest place for his money is a savings account. Every month, he deposits all $500 into the bank and never misses a payment. James takes a different approach. He still saves money every month, but only enough to build a solid emergency fund. Once he reaches that goal, he begins investing the rest of his money into low-cost index funds. Neither of them is trying to get rich overnight. Neither is taking crazy risks. They're simply following two different financial strategies. Fast forward 30 years. Both worked hard. Both earned similar salaries. Both were disciplined with their money, yet one of them has built far more wealth than the other. The difference wasn't luck. It wasn't higher income, and it definitely wasn't winning the lottery. The difference was understanding how money actually works. Before we talk about investing, we first need to understand why saving is important, and why by itself it isn't enough.
Saving money is one of the smartest financial habits anyone can develop. Without savings, even a small emergency can turn into a major financial problem. Imagine your car suddenly breaks down. Your laptop stops working right before an important project. Or you unexpectedly lose your job and need money to cover your rent, groceries, and daily expenses. Without an emergency fund, many people have no choice but to rely on credit cards or personal loans. What starts as a small setback can quickly become a cycle of debt that's difficult to escape. That's why financial experts recommend building an emergency fund before focusing on investing. An emergency fund isn't designed to make you rich. Its purpose is to protect you from life's unexpected surprises and give you peace of mind. So yes, saving is incredibly important. But here's where millions of people make a costly mistake. They believe that simply saving more money will eventually make them wealthy. Unfortunately, that's not how money works. Let's say you save $10,000 and leave it in a traditional savings account for the next 20 years. At first, everything seems fine. Your money is safe, your bank balance hasn't disappeared, but something is happening quietly in the background. Every year, the cost of living continues to rise. Food becomes more expensive. Gas prices increase. Housing costs go up. Healthcare gets more expensive. This invisible force is called inflation. Inflation slowly reduces the purchasing power of your money. In simple terms, the same amount of money buys fewer goods and services as time passes. Imagine buying a cup of coffee for $3 today. 10 or 20 years from now, that exact same coffee could cost $5 or even $6. Your money didn't shrink, but its buying power did. That's why keeping all your money in a savings account for decades can actually make you poorer in real terms. Your account balance may stay the same, but the value of that money slowly declines year after year. This is one of the biggest financial lessons most people never learn. Saving protects your money, but it doesn't help your wealth grow fast enough to stay ahead of inflation. So if saving alone isn't the answer, how do wealthy people make their money grow over time? The answer begins with understanding one powerful concept called investing. So, what exactly is investing? Simply put, investing means putting your money into assets that have the potential to grow over time, instead of letting it sit in a bank account. Think of it like hiring your money to work for you. When you go to work, you earn money. When you invest wisely, your money has the opportunity to earn even more money. That's one of the biggest differences between saving and investing. Saving protects your money. Investing gives your money the chance to grow. There are many different ways to invest. Some people invest in individual stocks. Others choose exchange-traded funds, also known as ETFs. Many long-term investors prefer low-cost index funds because they spread your investment across hundreds of companies instead of relying on just one. Some people invest in real estate. Others invest in bonds. Each investment has its own level of risk and potential reward. But here's something every beginner needs to understand. Investing is not the same as gambling. Many people avoid investing because they think the stock market is just another casino. That's one of the biggest financial myths. When you gamble, the outcome mostly depends on luck. When you invest, you're buying ownership in real businesses that create products, provide services, and generate profits. As those businesses grow, your investment has the potential to grow as well. Of course, markets don't move in a straight line. Some days prices go up. Other days they go down. Sometimes the market can fall sharply for weeks or even months. That's completely normal. Even the world's biggest companies have experienced difficult periods, but throughout history, the overall stock market has continued to grow over the long term, despite recessions, financial crises, and global uncertainty. That's why experienced investors don't panic every time the market drops. They understand that short-term declines are simply part of the journey toward long-term growth. And this brings us to one of the most powerful concepts in personal finance, a concept that has helped ordinary people build extraordinary wealth over time. It's called compound growth. Once you understand how it works, you'll never look at money the same way again.
Compound growth is often called the eighth wonder of the world, and for good reason. It's the reason why many ordinary people become millionaires. Not because they earn huge salaries, but because they give their money enough time to grow. Here's a simple example. Imagine you invest $100 and earn a 10% return in your first year. By the end of the year, your investment grows to $110. Now, something interesting happens. The following year, you don't earn returns on just your original $100. You earn returns on $110. Then the year after that, your returns are calculated on an even larger amount. In other words, your money starts earning money, and then that new money starts earning money too. That's the magic of compound growth. At first, the progress feels slow. It may even seem like nothing is happening. But over time, the growth begins to accelerate, almost like a snowball rolling downhill. The longer it rolls, the bigger and faster it becomes. Now, let's compare two investors. Emma starts investing at the age of 25. She invests $300 every month. David waits until he's 35 before he starts investing. To catch up, he invests $500 every month. Even though David invests more money each month, Emma often ends up with a much larger investment portfolio. Why? Because she gave compound growth an extra 10 years to work its magic. This is why financial experts often say that time in the market is more important than trying to time the market. No one can consistently predict the perfect day to invest, but anyone can benefit from staying invested over the long term. Every year you delay investing is another year your money loses the opportunity to grow. Of course, this doesn't mean you should invest money you'll need next month. Money for rent, groceries, emergency expenses, or upcoming bills should always remain in your savings account. Investing works best for long-term goals like retirement, financial independence, or building generational wealth. Once you understand the power of compound growth, one thing becomes clear. The biggest obstacle to building wealth usually isn't a lack of money. It's the financial mistakes that stop people from getting started in the first place. Let's take a look at some of the most common mistakes and how you can avoid them. Now that you understand how investing works, let's talk about the biggest mistakes that prevent most people from building wealth. The first mistake is waiting for the perfect time to invest. Many people say, "I'll start when the market crashes." Others say, "I'll invest after I get a better job," or "I'll wait until I have more money." The problem is that there's always another reason to wait. Weeks turn into months, months turn into years, and before they realize it, they've lost one thing they can never get back: time.
The truth is, nobody can consistently predict what the market will do tomorrow, next week, or even next year. Not professional investors, not billionaires, not financial news channels. Trying to perfectly time the market usually leads to disappointment. Successful investors focus on consistency instead of perfection. Another common mistake is letting emotions control financial decisions. When the market is rising, people become excited. They see headlines about investors making huge profits and suddenly feel like they're missing out. So they buy when prices are already high. Then, when the market drops, fear takes over. Instead of staying calm, they panic and sell their investments at a loss. Ironically, they buy high and sell low. The exact opposite of what successful investors try to do. One of the smartest ways to reduce risk is through diversification. Diversification simply means spreading your investments across many different companies, industries, or asset types instead of putting all your money into one place. Imagine placing every dollar you own into a single company. If that company struggles, your entire investment could suffer. But if your money is spread across hundreds of businesses, one company's poor performance has a much smaller impact on your overall portfolio. That's why many long-term investors prefer diversified index funds. Finally, let's talk about a silent wealth killer that many people never notice: lifestyle inflation. As income increases, spending often increases too. A bigger paycheck leads to a bigger house, a newer car, more expensive vacations, luxury gadgets. And before long, every extra dollar is being spent instead of invested. Financially successful people often do the opposite. When they receive a raise, they increase the amount they invest before increasing their lifestyle. That one habit, repeated year after year, can create an enormous difference in long-term wealth. So if you want to build real financial freedom, don't chase perfection. Build consistent habits instead. And that brings us to the final question. What does a smart financial plan actually look like for someone starting today?
Now that you understand the difference between saving and investing, let's put everything together into a simple financial plan that almost anyone can follow. The first step is to build an emergency fund. Before investing heavily, make sure you have enough money set aside to cover unexpected expenses. Many financial experts recommend saving enough to cover 3 to 6 months of essential living costs. This money isn't meant to grow quickly. Its purpose is to protect you when life doesn't go according to plan. Once your emergency fund is ready, begin investing consistently. Notice the word consistently. You don't need thousands of dollars to become an investor. Even small monthly investments can grow into significant wealth over time. The amount you start with is far less important than the habit of continuing to invest month after month. One strategy used by millions of successful investors is called dollar cost averaging. Instead of trying to predict the perfect moment to invest, you invest a fixed amount on a regular schedule. For example, you might invest $200 every month. When prices are high, your money buys fewer shares. When prices are low, it buys more shares. Over the long run, this approach helps remove emotion from investing and encourages discipline. Another important habit is thinking long-term. Many beginners check their investments every single day. They celebrate every gain and worry about every loss. But successful investing isn't about daily excitement. It's about patience. Imagine planting a tree. You wouldn't expect it to reach full size in just a few weeks. It needs time, care, and consistency. Building wealth works exactly the same way. Let's go back to Alex and James. At the beginning of this video, they earned similar incomes and saved the same amount every month. The only difference was how they used their money. Alex relied almost entirely on saving. James built an emergency fund first and then invested consistently for decades. Years later, Alex had financial security, but James achieved something even greater: financial freedom. Not because he was luckier, not because he earned millions, but because he allowed time and compound growth to work in his favor. And that's the biggest lesson from this entire video. Saving and investing are not competitors. They work best as a team. Saving protects your present. Investing builds your future. If you're just starting your financial journey, don't wait for the perfect moment. Start learning, start saving, start investing. Even if it's only a small amount each month, your future self will thank you for the decision you make today. If you enjoyed this video and found it valuable, make sure to like, subscribe, and share it with someone who's working toward a better financial future. Thanks for watching, and I'll see you in the next video.